Hello, and welcome back to Not Fintech Investment Advice. My name is Alex Johnson, and as always, I am joined by a refreshed and ready to tackle 2025 Simon Taylor. Simon, it's great to see your face.
It's great to see your face. I'm glad to know that you still have one. I miss doing this, my buddy. Something about not doing this show means I feel less relevant day by day. There's always a new fintech company. There's always something going on, and it's nice to be at it. It's nice to be doing this. It's nice to enjoy it as well. Like, not that I don't enjoy doing the podcast with you, but it's nice to enjoy like the nature of doing the day job. The rest does everything.
It is so true. Yes, we were talking about this before we hopped on, but there is something very healthy about taking a step back for a couple weeks so that you can get some perspective on like what's important, what's not important, what you missed, what you didn't miss. And I will say, and I don't know if you can relate to this, I find writing to be a chore, and I always have. Like I love doing it. It's really clarifying for my thinking. It's super valuable. But man, like a blank piece of paper is as scary to me now as it was in
Yes.
sixth grade when I wrote my first essay. But on the flip side, podcasting and just having conversations about fintech with my fintech friends, I could do this all day, man. I missed this for 2 weeks.
Bullseye. Thank you. You get me. You complete me. The hardest thing in the content game is to stay consistent because the
Yeah,
idea of writing another essay next week is it's exhausting, and yet the
it really is.
curiosity is the other side of that, which is like, no, I have to. It's really urgent that I do it, and
Right,
just to put
right.
that down for a little while was really, really nice. But now there's too many things happening, and I'm refreshed and ready to rant, my friend.
Excellent. Well, we're going to give you an opportunity to rant. We usually find some space for that in this podcast. As listeners know, our plan is to bounce through some fintech companies that have caught our eye recently. I got a chance, Simon, to sort of go through the archive in a slightly broader way. Maybe this is a benefit of taking a few weeks off, but I spent some time last night just sort of casting a wide net looking for interesting fintech companies, not necessarily brand new ones, but ones that I don't
Mm.
think we've talked about on the show and ones that were ones I hadn't really dug into or thought much about. So I'm looking forward to sharing those with you. And I know you're going to bring that same energy. Would you like to go first? Or would you like me to go first?
Well, I had a feeling that this might have been one we both picked.
Okay,
So I'm going to come out the gate with one, if that's all right with you,
go.
good sir.
Yep.
Dakota.
Yes. I have written about them. They were not on my list to talk about today, but I am fascinated. So why don't you go?
So Dakota is a stablecoin equivalent to like Wise, this multi-currency wallet, and for businesses, it's SMB focused. Or if like Brex and Wise had a baby, users can accept and send euros, USD, and the twist is all deposits are stored as stablecoins, and because they're stored as stable coins, they can potentially earn up to a 4% yield. And then you get all the standard features like a spend management card. And the service also has a smart router that is designed to help payments get to their destination as fast and as cheaply as possible. And they're saying, look, this is a 24/7 money movement service, which is not always possible with cross-border SMB solutions or growth business accounts and spend management cards. So there's a lot of like benefit here, but this one caught the sort of the eye of yourself and some others for a lot of reasons. Do you want to unpack sort of like why this initially caught your attention, and then we can kind of cover the merits of it, I suppose.
Yeah, no, I'd love to. So, as you said, I mean, I think like Brex and Wise having a baby is a good way to describe it, right? Because it's sort of a like a business neobank, so similar to like a Brex or similar to a Mercury, someone like that. But Wise is a really good call because it's very oriented around global payments. And so if you're a business, and I think they work with a lot of like crypto companies today as just an obvious place for them to start from a go-to-market perspective. And you have employees across multiple geographies. You have suppliers that you have to pay across multiple geographies. That stablecoins, as you and I have talked about in the past, are a good sort of foundational mechanism to build around, because a lot of the payments for those types of businesses will need to cross borders, and stablecoins can be good infrastructure for that. So that's the sort of basic structure. The reason they caught my attention specifically was that they're part of this kind of emerging trend, which I wrote about in my newsletter, of stable coins. And I know you've put a lot of good thinking into this. I think you have some stuff you're working on that's coming out about this. I actually do too. So it's very timely this week to be talking about it. This trend of stablecoins being kind of the central piece of infrastructure that like new banking products are being built around. And it echoes or rhymes the halcyon days of 2020 and 2021, where we were seeing kind of a similar thing with, I think we kind of call them the like DeFi mullet sort of approach, right? Where we were blending DeFi and TradFi together into these consumer or business banking products. The difference, though, is that stablecoins have kind of become the flavor of decentralized finance or crypto that seems to be kind of the hook that everyone is building around. And that's for good reason, right? Because stablecoins, by definition, are stable. They are sort of stripped of any of the sort of volatility or speculation that I think made some of the last round of products in this space maybe not work quite so well. And so Dakota seems like a very interesting sort of avatar for a larger trend. The thing I'm curious about, Simon, and I'd love to get your reaction to it, is I do wonder about the virtue of stable coins as a sort of mechanism of fund storage versus payments. So the payments part of Dakota makes a ton of sense to me, right? Like, we're going to use stable coins to move money across borders. It's going to be cheaper than correspondent banking or other things. It kind of allows us as Dakota, I'm sort of putting my Dakota hat on, it allows us to sort of catch up to Wise. Like, Wise has done this, but in a like non-stablecoin, non-crypto way. And it took a lot of time and a lot of investment to build up their sort of cross-border network. This sort of allows us to catch up much faster, which that whole part of it makes sense. The part I struggle with a little bit more if I'm a business, particularly like a business based in the US, is I'm not totally sure I see the virtue of storing my money as a stable coin rather than in a bank. And I saw some tweets and some commentary from the founder of Dakota that was sort of making the case that like it's better to have treasury bills and the US Treasury as your counterparty relative to like a regional bank that might fail. And I found that to be a very interesting statement, but one maybe that's worthy of interrogating a bit more.
Yeah. So I can see why somebody would make that statement.
Yes.
Because the full faith and credit of the US government is arguably zero credit risk. It's like the most low risk thing you can possibly hold if you have a US Treasury bill in your hands. However, that is not the case here. What you have is some custodian somewhere that is holding that on your behalf, which is generally the case for most financial products. They'll be SPIC regulated, SPIC, and they'll have a whole series of audits that exist around that. But then the question is, what happens between that US Treasury and the stablecoin issuer? For example, Circle and Tether and everybody else. And what happens between the stablecoin issuer and then the kind of provider of that stablecoin or the wallet at the front end, in this case, Dakota? We have seen this movie before with banking as a service. So the argument went that banking as a service, you're FDIC insured up to $250,000. Oh, actually, wait. Maybe you're not. And a lot of customers lost out. And it wasn't really clear. And when there's a lack of clarity, problems can follow because it turns out the world is messy and risky. There's an argument now that says, well, stablecoins are better than banking as a service because they're built on treasuries. Categorically, axiomatically not the case. Like that is just not true. However, there is a very real case to be made for stablecoins as a far better payment rail. In the
Yep.
DeFi days, we were talking about stablecoins giving you better yield because in a ZERP environment, like you're competing with 0%, 4%
You're not getting
sounds
anything
great.
else. Yep.
This is different. I fundamentally think that the value here is exactly what it says on the tin, what they're trying to sell you, which is 24/7 instant global money movement. If you want
Yeah.
that, then this is like a open loop, closed loop. It's the ability to move money to anywhere in the world 24/7 as a dollar, even when the banks are closed. That's awesome. That's going to take massive amounts of friction out of the system and be hugely valuable if you want to expand internationally or do anything along those lines. And you should go build products and services around that idea and many other ideas that are associated with it. But you are not safer because you are on a stable coin. In fact, some of the stable coins we've seen, Terra Luna has blown up, right? Like not
Yep.
all stable coins are created equal. So what have you actually got here?
Well, and it's a really great point, and I think analogizing it to banking as a service is exactly right, because banking as a service can be really safe or it can be really dangerous, and the devil is in the details, right? And so, the question that you really have, and you did exactly right when you were talking about custody, is, and this is the test case, right? If your company goes away tomorrow, what do I as a customer do to get my money back? And the great power of the FDIC, and I keep saying this, and I hope it will sink into for people over time, is the great power of the FDIC is not the insurance fund. The great power of the FDIC is the resolution office that goes into a failed bank over the weekend and connects all of your accounts and all of your debit cards and all of your checks to some new banking provider over the weekend that acquires those assets, so that Monday morning when the bank opens, your debit card works as it always did, your checks go through, you can log in and check your balance, everything just works. They resolve the problem. That doesn't always exist, right? So in the case of stablecoins, it's fine to say, yeah, you're keeping your money in US treasuries. That's fantastic. But to your point, first, I have to know who's issuing the stablecoin and what checks or what sort of validations there are that they actually are putting my money in treasuries and that it's being stored that way. And there are some very large stablecoin issuers like Circle where you could probably feel relatively comfortable that that's what they're doing. There's been concern over the years about Tether and whether they are or aren't doing that. So it depends a lot on who's issuing the stablecoin. And then the second point, which you also touched on, is okay, but just because it's backed by a stablecoin doesn't mean that I, Alex Johnson, customer of Dakota, if Dakota goes away, I can't call up the US Treasury and say, hey, I was a Dakota customer. You owe me $200,000 in treasuries because they said that I had it. There's going to need to be a chain of proof. There's going to need to be, for the benefit of Alex Johnson accounts sitting somewhere, they need to be remote from bankruptcy so they don't get pulled into that proceeding. So there's a whole set of devil in the details questions to make the deposit side of this work. And I'm not saying that Dakota can't do that, but the thing that concerned me when I was looking at their website initially was they would talk about stablecoins as, oh, stablecoins are great. They're very stable. They give examples like USDC. But Dakota, if I understand correctly, is actually issuing their own stablecoin rather than using like a USDC or a USDT, which is, again, there's a reason to do that from a business perspective, but that makes me nervous because I don't know anything about Dakota's stablecoin or what it's backed by or what the reserves are. And then there was very little information on what that unwinding or resolution process would be and how that would work and how they keep your assets bankruptcy remote. So Austin Campbell actually tweeted about this a little bit when he was saying there's a way to make this work, but the devil is in the details. I couldn't agree more with you about the payment side of it. To me, that makes much more sense. And the last point I'll just make before we move on is, and you were the first one I think who kind of made this point to me initially with stablecoins. Everything I'm talking about with deposits and the relative safety of where to keep your money, that's very much of a US lens on it. If you live in Argentina or Venezuela and you're getting paid by a company, the virtue of being able to keep your money in a stable coin rather than converting it to your native currency, that might be a completely different value proposition, right? And so if you live in a country that has a less stable currency, the value of keeping your money in a stable coin, even if some of these other questions we're talking about aren't totally clear, the value still might be much greater. In the US, there's a different calculation.
we're in the dial-up era of stablecoins. I think we're going to
Yeah.
very quickly move away from the which flavor of stablecoin would you like? Would you like it with a C on the end, or a T on the end, or a P? Like,
Yeah.
I don't have a different flavor of dollar depending which bank I have, but really what that letter denominates is what the credit risk of the stablecoin is. So
That's right.
the credit risk of holding a dollar in different banks is theoretically more or less the same because of FDIC
Mm-hmm.
coverage, but with stables it's a little bit different, right? But we
Yeah.
still call it a dollar. A dollar is a dollar. But in this crypto world, we've got all of these different flavors of dollars, and then we've got all of these different networks, and so it's just really janky and a horrible user experience. But if you can overcome that, then you
Yeah.
get to this world in which I can hold something that's a lot better. And as I said, not all stablecoin issuers are created equal. That's both a good thing and a bad thing. Things can go
That's
horribly
right.
wrong, but there are some that are really excellently run and that could be, a major part of the future financial system. So that's
Yep.
exciting. And what I think happens next is you see this flywheel effect because the US dollar has arguably the best product market fit of any product in history. You go anywhere around the world and people want dollars. That's what they want.
Yep.
Then that's opening up markets. And as it starts to open up markets and trade flows in the global south, that is where all of the growth is going to come from, is a lot of these global south markets and entrepreneurial
Mm-hmm.
spirit where there are young populations, where there are growth in entrepreneurs. If you are going to get that kind of long tail growth and you're going to be able to trade with it, you need some sort of payments rail that naturally works for those markets. So this proposition, if it were just sort of positioned that way, which I think it now is, they may have
Yep.
responded to some of the Twitter stuff, is
They may
amazing.
have, and they're very early, right? Yeah, for sure.
Wise plus Brex is absolutely killer for where the world is going, and I think it would be hugely successful. And my hope is that these entrepreneurs, many others like it, learn these lessons and kind of we all came into payments once, and some old guy said, "Oh, young kid, let me teach you about credit risk." And now I'm that guy. So, good on you for trying something new. I think the proposition's really got something, and I think stablecoins will be. We'll talk about being unstable as we talk about being online. They will be a layer above the existing payments infrastructures, and they will become the connective tissue for all payments rails around the world. That is a question to me of when, not if. So you're absolutely skating in the right direction if you're heading towards stablecoins.
Yeah, no, I totally agree. And for folks listening, I think by the time this comes out, actually, I think Simon and I both probably will have published some more content on how to think about stablecoins. So be sure to check that out. But this is, I think, a very good directional conversation, not only for the stuff we're kind of thinking about and writing about, but also, Simon, because it is not totally unrelated to my next company. Ready?
Ooh, go.
All right. So speaking of deposits and all things on the deposit side, my first company is one called Ampersand. So they are essentially a deposit aggregator. They were founded by a couple of sort of longtime bank executives after the failure of SVB. So like later in 2023. And essentially what they do is they take large cash deposits and spread them out over a network of banks in order to optimize companies' treasury management strategies, right? And so what's interesting is that optimization can cross a couple of different sort of lenses of value, right? So if you want to optimize for safety, they can help you with that, right? So you have $5 million, you want to make sure every penny of it is insured and safe because you don't want to go through what a bunch of SVB's customers went through over that weekend. They can help you spread those deposits out in $245,000 increments across a network of banks to make sure they're fully insured. You care about rate. They can shop around on your behalf and make sure that you're getting the best rate spread out across a number of banks on your deposits. If you care about where you're keeping your money from a value perspective and making sure that your dollars are being held with banks that are committed to serving their communities and that have a certain sort of ethical alignment that matches up with what you're hoping your money can accomplish, they can help you do that. Or, as great optimization does, they can do any mix of that and dial it into exactly what you're looking for. So essentially, you come to them with your large cash deposit, and they optimize where to put it across a number of different variables using machine learning, using technology to help sort of automate that process. This is really interesting to me because we've actually seen a lot of innovation in this space over the last couple of years, right? So deposit brokers, deposit aggregation, deposit sweep networks, these things aren't new, right? They've been around for decades. There's lots of legacy players like IntraFi and R&T and Stonecastle that do this. And we've seen some newer providers like ModernFi come in and try to compete with the IntraFis and R&Ts of the world. The thing that's interesting to me, though, is most of those providers kind of work exclusively on the back end, right? So they're all solutions for banks or solutions for fintech companies. And so, a ModernFi or an IntraFi will go to a bank, or they'll go to a neobank and they'll say, hey, use our service and we can increase your deposit insurance coverage. We can put your deposits to work behind the scenes. We can do all of that. But what's interesting, Simon, is, and I've been kind of surprised by this, a lot of banks don't take as much advantage of those deposit sweep networks and those deposit aggregators as I think they could or should be, right? So, like, as an example, I think post-SVB, it's insane that any bank has any customers that have uninsured deposits. Like, unless you're Chase or one of the big, too big to fail banks, any other bank, their ratio of uninsured deposits should be zero, right? Post SVB. Like, it's just crazy to me that you would do that. But despite the existence of IntraFi and ModernFi and all of these banks, or all of these deposit sweep networks, a lot of banks don't really want to push their customers towards these products. They don't want to spread their deposits out across the deposit sweep network. Part of it, I think, is they don't want to pay the fees associated with doing it. It kind of reminds me of, like, I don't know, someone not getting life insurance because they don't think they're going to die, right? Kind of a thing where it's like the responsible thing to do is to get life insurance. Just get it because stuff happens and it's better for everyone if you do. But a lot of people are just like, I'm not going to die. I don't want to think about dying. I'm not going to get life insurance. And it strikes me that a lot of deposit innovation on the back end doesn't trickle down to companies and to end users because their banks don't want to think about themselves failing and what that would mean for their customers. In addition to that, from a deposit broker perspective, banks have no interest in shopping your deposits around to get you a better rate, right? Like, they want the sticky, low-cost deposits because that drives their business model. And so the thing that's interesting to me about ampersand is they are not operating in the back end. They are going directly after companies that have these large cash deposits. And in a post-SVB world, you can imagine, like a bakery or something that has this large deposits. Oh, I always thought it was safe just keeping it with my bank. I no longer think that way. What should I be doing? And ampersand is a tech-forward sort of almost a combination of a deposit broker and sort of a deposit aggregation service. And I think that's interesting. I think there actually is maybe more room in the market than I had initially thought for serving customers directly with deposit placement and deposit aggregation solutions rather than just serving banks and hoping those benefits trickle through to the end customer. Does that concept make sense to you?
It does, because immediately the question was, who's the ideal client of this? Because I think about treasury management at a corporate, and this is, they care about two things, risk and kind of efficiency. Right, a treasury management, a chief treasury officer at Coca-Cola or at like global corporates, Procter and Gamble, is considering how they move their money around the world in the lowest risk way possible, but they're managing it like a bank would. They're also trying to be as efficient as possible, and where their risk appetite is may vary. If you're a mid-scale legal firm that operates in a lot of states, or if you're in commercial real estate and you're a certain size, and that sort of like certain size of company, you don't have a chief treasury officer. You probably got a CFO, and you are probably
But
trying to do some of this stuff, and maybe using some fintech companies who are doing this
yeah,
before for you. But
yeah,
maybe you want your deposits to work harder this week, this month, and there's a lot of like the neobanks in the B2B space have offered this sort of like, well, we'll just take care of that for you. I know the
yeah,
guys at Arc, for instance, actually consult a lot more with their clients, help them figure
yeah.
out, how do you build your treasury management waterfall, and how do you
Mm-hmm.
as a growth tech business think about that? Like that's
Mm-hmm.
their niche. That's what they've really carved out, is like being the bank that's sort of like your friendly, will help you learn treasury management guru.
Yep.
There's a whole bunch of the market that's not a growth tech company. And
Yeah.
how are they going to move it around? And yeah, that they're not going to get this answer from their bank. The legal firm that's of mid scale that operates regionally isn't going to get that from their banker necessarily. Their banker will talk to them about it, but a bit
Mm-hmm.
like you walk into a branch and are they going to give you advice? Yeah, it's going to be kind of generic and not really suited to you, and then they're going to push product. That's kind of what you get if you're this level of corporate. You're not necessarily getting that tailored advice that Procter and Gamble or Coca-Cola is getting from, like all of the banks that are moving around with them and their chief treasury officer and their treasury team of people that might be 10, 20, 30 people. So fascinating. Really is very Alex Johnson of you to find this like weird esoteric thing off to the side that people hadn't considered. I love that you found this one. So how are these guys doing? Are they succeeding? What's next for them? What are your thoughts there and like the future?
Yeah, it's a great question. So they are relatively new. So they're like a year old, roughly. Came about after the failure of SVB. The CEO founded a company that did something very similar to this prior to launching this company. And so she sort of has come in and out of the private equity world. I think this company was sort of spun out of a private equity firm that focuses in the community banking space. And they also raised, I think, a little money from Jam FinTop. Do you know those guys that do
Yeah.
the investing on behalf of community and regional banks? And so I think the general principle is they are going to target like that category of company that you were talking about. And it's funny, right? I was thinking about the failure of SVB, and one of the things that was so interesting was in the wreckage of all of that, one of the things that became apparent was yes, there were certainly a lot of like tech companies banking at SVB, VC backed tech startups banking at SVB. There were also a lot of just businesses banking at SVB, right? And so, like, I think we sometimes sort of misunderstand the market a bit when we think, like, yeah, there's the VC tech startup ecosystem, and then there's large corporates, and there's nothing else in between. And in fact, most of the economy is in between, right? It's those other things. It's a vineyard operator. It's a mid-sized construction firm. It's a law office, right? It's all of these other businesses that are not small businesses. They need treasury management, but they're not big enough to have their own whole treasury management and chief treasury officer and all that kind of stuff. So I think you're exactly right about the target market. And my sense is that because they're coming out of the banking world and they have investors that have banks as LPs or that have invested in banks, they're very tightly tied into the community banking space. And I think the idea there is they can also serve that side of the market. And so the deposit network that they're assembling, I imagine, is made up of a lot of those banks. I could even see some of those banks either white labeling or referring their corporate customers, their commercial customers to this service or using this service. So I imagine those banks could both be sort of a balance sheet and part of their network, but also potentially a point of distribution. So very early, these guys I don't think are going to follow the typical VC-backed hyper growth scaling model. I don't get the sense that that's how they're approaching go-to-market or growth. But early traction suggests that they have the right team, they know what they're doing, and they're going after this segment of the market.
Fascinating. I wish them
Yeah, I
well.
thought you'd like that one.
It's the most Alex Johnson startup I think I've ever seen. I love it, but you do get this in the US banking industry, possibly more so than anywhere I've seen in Europe, which is
Hmm.
um, bunch of folks with a lot of industry experience go do a thing for this segment of the market, and it does really well, but it doesn't need to be VC backed. And it is something to pay
Yes.
attention to, because if you want to understand where innovation comes from in the US market, it's typically from this size of bank behind the scenes. So knowing where this moves gives you everything else.
Yeah, no, I totally agree. And speaking of this being a very Alex Johnson pick, it's also a very Jason Mikula pick, our friend at FinTech Business Weekly, because as I was doing research on these guys, I came across a podcast interview that Jason did with the CEO of Ampersand a while back. And so if people are listening and want to dig even more deeply, I would definitely recommend checking out that podcast. So it's just levels of fintech and banking nerdery all the way down here, Simon. All right, give me your second company.
My second company, I could have picked countless ones in this category, but I'm going with Auquan. So it's Auquan. I think that's how you pronounce it. Auquan.
That sounds
Auquan.
right.
They say they're automating deep work in financial services. So they
Mm.
provide AI tuned for use cases like creating credit or investment committee memos, new deal screening. And it says it's got clients like MetLife and UBS, as well as a top 10 asset manager using the product in production, taking tasks from 20 hours down to 5 or 10 minutes. So here's why I liked this one, because I find it incredibly hard to find really good case studies of Gen AI in production. There's
Mm.
probably, like, everybody talks about Klarna, and people have their opinions on Klarna. And if you
Hmm.
go to the OpenAI website, you can find, one or two banks that have one or two use cases, but it's this like one MVP use case or this one proof of concept that they did and this one pilot, and it's sort of slowly rolling out, but it's not something that materially changes your workflow forever. What this gave me is citable examples where it's not just Gen AI builds a really good minimum viable product or a really good demo, because everybody has blitz scaled. Like with Cursor and Repli and V0, you can hack together a pretty good MVP of a product and a business incredibly quickly and incredibly cheaply and build something
Hmm.
that looks like Auquan. But the problem with Gen AI, and I'm sure you've had this,
Yeah.
is quality and consistency. Like,
Yeah.
I asked the LLM this yesterday and it didn't happen. And now it did, and it's amazing. What the heck? This
Yeah.
is this is
Yeah.
so inconsistent. I'm trying to run a business here. This isn't
Yep.
possible. And so there's a quote on the homepage from one of the asset managers, which is, "This is the first time I've seen this work consistently. So often, AI agents promise you the earth, but don't quite stick the landing. And in the longer term, your brand is your consistency is your brand. So that is never going to be more true in an age of AI generated slop. Like, I don't know if I can look at another social post that is filled with emoji where it starts out with imagine, not just a picture of the future, a landscape of the future. And it's like it's a dead giveaway that you've asked ChatGPT to come up with a social post. And that slop, just that obviously AI generated image, people are already getting bored of it. The algorithms are already dinging it. So do something different. The same is true if you're building an AI product. And the same is true if you are trying to get that to get traction. And there are a handful of companies like Harvey, like seemingly this one, that are actually able to get products to production and have customers willing to say, yes, we're using it and yes, it works. So the idea that the foundation model was going to be what wins everything, that Microsoft and Copilot was going to take over the world, is actually shifted to the vertical stack, and being a bit of a specialist in your industry is a real differentiator. And that appears, unless it's just great marketing and I've fallen for it, to be what these guys have achieved.
Interesting. I like it. So just to sort of clarify, the sort of deep work that we're talking about and that they seem to specialize in is in the sort of private equity, private credit, asset management, investment banking sort of space generally,
Yes.
right? And so we're talking about highly manual, oftentimes very sort of bespoke deals or transactions where you're generating an investment memo, you're doing deal comparisons, you're doing due diligence, you're, in the case of like private credit, you're monitoring the performance of companies, you're monitoring the debt covenants you have, you're doing sort of benchmarking in the industry. So it's like you think of having these sort of investment analysts that work at these types of companies and the amount of work they're doing. And what Auquan is saying is by combining AI, by combining generative AI and LLMs with a very, very deep understanding of these workflows. And, Simon, to your point, like the magic, and I think this is true generally, seems to be, like with LLMs and generative AI, it's an engineering problem, right? Not an AI problem, right? Like it's really much more a function of how are we incorporating it in our workflow? These guys seem to use a lot of stuff we've talked about before, like vector databases, retrieval augmented generation, pre-processing of data. Like, so they're essentially designing the use of AI around these very narrow, well understood, deep back office use cases where we're not asking it to do things that it's a stretch to do or where we're going to get inconsistent results. We're leveraging it to, in the words of a panel that I saw when I was in DC last year on AI, it was like Max Levchin from a firm and someone from Andreessen Horowitz. There were some really smart AI people on the panel, and they were saying like, it's really good at summarizing, right? Like if you point it in the right direction and give it the right parameters, it's amazing at summarizing. And it seems like they're essentially taking advantage of its sort of incredible data summarization capabilities to go, generate a draft investment memo for this company. And if it's tied into all the right places and has the right data and is looking at the right vector databases, it can summarize those companies and save, orders of magnitude of time for those analysts that they would otherwise sort of be wasting. Is that the sort of general idea?
Bullseye. The productivity gain here is enormous. Like I think there's
Mm-hmm.
actually going to be a really big question about how do you get a day job in capital markets, because the expertise you need
Yeah.
to understand this often is by doing the grunt work yourself and doing some of the
Yeah, like we're sort of ruining the grinded out 80 hours a week career path for 10 years
yeah.
to learn the basics of a business thing. Like, not that I'm weeping tears for future investment bankers or anything, but like that is kind of what we're doing here.
What the other thing here? So yes, you're spot on with all of that assessment, right?
Mm.
There are all of these esoteric workflows where the raw LLM is a commodity. Everybody's paying their
Yeah.
$20 a month to somebody. The LLM is the commodity. The engineering you do around the LLM is what gives you the results and the consistency. And that
Mm-hmm.
is where these companies are really starting to differentiate and make a difference. And the unlock here is the big reason I think fintech hadn't penetrated capital markets was
Mm.
because there's so much unstructured data that you need to be able to understand and summarize in order to drive the workflow in the first place, which is where you have a
Right.
handful of fairly well paid junior analysts doing that ugly
Mm-hmm.
grunt work because it's so critical that you get it right. And now
Mm-hmm.
a lot of that grunt work, you can do it to a pretty high standard, but you need it to drive the workflow and you need it to have some level of consistency. So I think we're going to see,
Mm-hmm.
I mean, in the past few months, I don't know how many companies I've seen in this category, but the amount of them that can point at clients and customer references are vanishingly few, as is
Mm.
often the case. So I think we're going to see a lot more. It's an area I'm fascinated by. One of the few things as a journeyman in fintech is I've worked in almost every sector, like from consumer to commercial to corporate, and a little bit of time in capital markets as well. And when you see across all of that, you see that these silos, like the people have lived in one or two of these categories, very rarely the other ones. And my cap markets friends were always sort of pointing at me going like, that fintech stuff's never going to eat us. And now I think the unlock is actually this is the area we should be focused on for the next wave of potential future fintech disruption.
Yeah, no, I think that's right. I mean, it kind of strikes me when you talk about like where fintech can sort of penetrate in. It's like the instinct on the part of capital markets people wasn't wrong, right? The instinct was, look, this is something that kind of requires like human-like intelligence to do, right? Like there is no simple automation here that's really going to add a ton of value. So fintech in a sort of fintech 1.0 version was seen as like simple automation, removing humans from the loop where they never should have been before. And folks working in capital markets, folks working in, I mean, pick all your other areas, right? Where we know that, AI is now making, headway, fraud, compliance, these like kind of back office areas. There was a very legitimate sort of critique of fintech, which was like, don't try to automate a thing that you don't understand. This is way more complex. There's a reason human beings are here. Yes, we had human beings in other places where they never should have been, and fintech can remove those, totally buy it, but that's not true everywhere. But the assumption was you're never going to have an automated system that can deliver human-like intelligence in workflows that can replace that or augment that. That was true until large language models and generative AI came along. And now, and I was talking to Mitch at Basis, the AI accounting firm, right? And he was saying that like a way to think about this is it allows you to insert points of human intelligence in workflows in an automated fashion. And that's just like a totally different way of thinking about where fintech can penetrate into these spaces. So I very much agree with your framing there. And it's a credit to Auquan that they've been able to get actual traction and quotes from these types of institutions on their homepage. Because you're right, like that seems to be the differentiator. Simon, can I give you my last company?
Please do. I'm excited for this one. Hit me.
Well, so this one's probably one that you have heard about, or maybe even talked about a little bit on the show, referencingly. I don't know that we've really covered them specifically, but it's Tyme, Tiyme.
Yeah. Why do I know these guys?
Well, so I knew that the name would tickle your brain, and when you look them up, I'm sure you'll recognize them because you're much more the global neobanking guy than I am. But Tyme, based out of
South
Singapore.
African.
Yeah. And so they basically have, both in the Philippines and in South Africa, sort of sub-brands under the Tyme brand. One is TymeBank. I believe that's the South African one. And then GoTyme is the one that's in the Philippines. And across those two markets, they have, I think they claim about 15 million customers across those two markets. And so they've essentially built a new bank-like digital bank sort of playbook and stack that they are sort of attacking individual markets in that Southeast Asia, sort of Africa sphere of the world, those emerging markets. Now that they are sort of expanding across multiple markets, I'm trying to think of them a little less like an individual neobank that's sort of dominating one region and expanding to another region, and a little bit more like McDonald's in the sense that like we know what model works in emerging markets in a digital banking context. It's different than in more mature markets like the US or the UK or Australia or wherever. But for the markets where we know this model works, we can franchise it. We can expand into other markets. And so they're talking about going into, I think it was like Vietnam and some of the other markets that are sort of similar and within their general sphere of the world. The reason I thought these guys were really interesting, Simon, is that they recently raised, I believe, a Series D round of $250 million. And that round was led by Nubank, which invested about 150 million of that 250 million to get a 10% stake in Tyme, right? And so you did a whole wrap up of fintech in 2024, great like presentation that Simon spends a ton of time on. And the word that you used to sort of describe the overarching thing was hyperscaling, right? And so the thing I was thinking about when I saw this news was Nubank investing in another digital bank sort of that's figured out this playbook in a different part of the world kind of makes me think that we're entering this world of like almost franchised neobanking for emerging markets where whether it's you or whether it's a company you invested in, they're all sort of connecting to each other. And the recognition is, look, there's so much greenfield opportunity for us to steal customers from legacy banks in these markets that aren't serving their customers well, or as we've seen in a lot of these markets, to grow the pie by bringing customers into the banking system that weren't in it before. And I guess until I saw this news, I hadn't really thought of like these companies connecting with each other on a global scale. I had always sort of thought of this more in the model of like Nubank is in Brazil. Now it's trying to expand into other markets in Latin America. You have banks in India that are trying to get into the rest of Southeast Asia. You have one that starts in one country in Africa and starts to grow. You have Revolut that dominates in the UK and then they try to jump to the US or other markets. That's been more the playbook, but this almost seems like we want to invest in a global infrastructure for bringing digital banking to emerging markets. And different companies are going to have different playbooks that work in different sets of markets. But it almost seems like there's more like cooperation or co-opetition that's happening rather than everyone thinking like, we're going to win in one market, jump to the next market, and just like knock them out one at a time. So I thought this new bank investment was really interesting and hints at a slightly different future than the one I thought was coming.
Yeah, same. Fascinating. So, having looked closely at Revolut a lot in the past sort of 6 months, they have consistently been able to get into new markets. They finally got their charter in the UK, which people said they would never do. I was one of them. I honestly thought it wasn't going to happen, and they proved me wrong. Like, credit to them. And they have a banking license in Mexico. They're applying for banking licenses just about everywhere, and I think they will get them. And so they're doing the classic, like, we will expand as us with our tech platform and we'll replicate and roll out. But to your point, the franchise model looks a little bit different. The menu in Tokyo for McDonald's looks very different to the one in the US. And the franchisee looks different right down to the last mile. This is a little bit different, but something really interesting because Revolut's doing that global expansion, but so is just about every hyperscaler fintech company. Like, I think we've entered the age of the fintech hyperscaler, 10 to 20-year-old companies that have to look outside their domestic market for where their growth is going to come from. Brazil, there's still a lot of room to run with product expansion for sure, but they're moving into other markets. This is a really nice lateral move because where next for Nubank after they do their adjacent markets in the region they're in? Where do they kind of get that top line growth from? And if there is a playbook that works, this is interesting. This is really, really interesting. If I'm sitting in a bank, this changes the calculus dramatically.
Yeah, I totally agree with that. And it's really interesting to sort of compare it to, like, I'll just pick on Citi as an example, right? Because Citi under Jane Fraser is going through a whole reorganization where they're basically like stripping back a lot of the global expansion that they had done over the last couple of decades. And I think it sort of hints at, it's really hard, not so much in like a commercial banking or correspondent banking way, but like in a retail banking way. It's really hard to pick up this big, heavy bank that you built in the US or the UK or wherever and take it to another market. You can do it. Citi's done it. HSBC has done it. But then it comes with a lot of like heavy costs. And then over time, those costs might sort of weigh on your profits and then you have to cut them back. And so I guess I had never thought of like, what does the Citi HSBC model of international retail expansion look like in a digital age? And I think Nubank and Time sort of hint at like directionally what that looks like, which is, look, let's come up with a much lighter weight model. We can go into these markets. We're going to refine a playbook that works for these markets. And I think what's interesting about this investment and the quotes from the story sort of hint at this is like, I think Time looks at it and says, hey, Nubank knows a lot about scaling in these types of markets. We can probably learn stuff from that team. So them having a 10% stake in us is probably good for us, not just financially, but from what we can learn and benefit from them. And then I think the same thing is true as you were saying, Nubank probably doesn't have the arrogance to assume we can just pick up a carbon copy of Nubank and drop it into the Philippines and win the same way that we did in Brazil. Like our adjacent advantages run out the further that we try to expand. And so let's try to do this in a smarter, more capitally efficient way. So I think it is a really interesting view of the future. You're absolutely right. Like every financial services company eventually needs to hyperscale across multiple geographies. But the way that they did it in the HSBC City days, it's not going to look like that in the future. It's going to look different.
No, your cost structure is an order of magnitude different for a new bank than it is for somebody else. And if you're going into new markets and you're trying to do it with a mainframe or by acquiring a local bank that has a mainframe, that model just isn't going to stack up against something like this. So how do you expand? Immediately, though, you look under the hood of most of the HSBCs of the world, and what you see is like 35 little banks in a trench coat. Like these are all roll up. I mean, have you ever seen the family tree history of JP Morgan Chase? There are so many banks that go into, and there are so many different mainframes that they've actually done a fairly reasonable job of consolidating compared to some others. But you look under the hood of a lot of the European banks, and you see all of the banks that used to be there with a different logo at the top. Like they've still got teams, they've still got physical offices in different places. Those teams don't necessarily talk to each other. It's like it's M&A, but it's not. It's sort of like an acquisition that we shared the same logo as, and we shared the same P&L, but we never really merged. This could be interesting because it gives Nubank particularly a window into their possible future or a potential acquisition where what is Nubank great at? They're great at product execution and tech execution. Like arguably one of the best run technology businesses in the world, period, when it comes to their execution side. So their platform is ultra low cost, ultra scalable. Dropping that in other markets, if you could do it, could be really, really interesting. They've got a lot of lessons learned. How do you figure out if the franchise model is right, or how do you potentially just take somebody that's already in some other markets and help them expand? Really, really interesting.
Yeah, no, I thought so too. I think it'll be really interesting. The optimist case, I guess, for 2025 around some of this stuff is, if you have all that cost that you're carrying, the problem is you're going to have to focus on the top of the market. And you see this a lot with the cities and HSBCs of the world. Like when they expand into international markets, it's to go get great commercial business or great high net worth business. But they don't really give a shit about unbanked people in some new market that they're expanding into, because the revenue generated by those customers can't pay for their overhead and their costs that they're carrying in those markets.
Exactly.
This would allow for a much more scalable and efficient way to enter those markets, which I think could really lead to an increase in the overall banked population across all of these regions. So it's a really interesting sort of, macro theory on where we might be going. Simon, before I let you go, if you don't mind, could I ask you to manifest something you'd like to see in fintech? And remember, this is your first manifesting of 2025. So think big.
Yeah, no, my first manifesting of 2025 is probably a familiar theme for me. So I'm gonna throw it out there to you, but I want the fintech company that wins at supervisory technology. If we are going to bring efficiency into government, and if we are going to transform that stuff, who's the Palantir of fintech? Who's going to go and give all of the supervisors the superpowers? And I really want that to exist. I know there's a lot of people that have tried to do it, but getting through that door has been extremely hard. And there's a lot of fintech companies that could do something along these lines. But I want to manifest A, that company, or B, that solution, because I don't think that it's a good thing that we look at government and say everybody who works in a supervisor and a regulator is inefficient. But I do think the reliance on consultancies and third parties and kind of a lot of the way we've done things might not necessarily be the right answer. So if we are going to use the technology, let's use it and let's manifest it to actually reduce risk and to improve oversight, and to do so in a way that benefits the industry. So manifesting supervisory tech.
I love that. I would just add to that it's so funny, but my biggest goal for like the Department of Government Efficiency and this focus on efficiency in the U.S. government that's coming under the next administration. My biggest sort of sub goal that fits under that is not reducing redundancy, right? So you're seeing a flavor of this, which is like, hey, why do we need all these agencies? Let's cut X, Y, and Z. Like, a lot of those exist for good reasons. But
Yeah.
I would love to see, hey, we're not necessarily saying, like, let's cut all these agencies. Let's just make them way more efficient. Because when you look at a bottleneck that exists in, like, just a lot of banking things in the US, a lot of it comes down to how efficient supervisors can be in dealing with all the companies they supervise. And when you ask questions like, hey, we'd love it if someone would more directly supervise fintech companies. And even fintech companies are raising their hands saying, we want to be supervised because it's a good signal for the market. Regulators are saying, yeah, we'd love to, but we don't have the people to do it. And we're not efficient enough at doing it. So regulatory efficiency, particularly from a supervision standpoint, I'm all in. +1 on your manifest. And I would love to see that. And I think we actually stand a good chance of getting some progress there. I'll build on yours for my manifesting in 2025, which is I would like a similar type of thing to exist and to enable government regulators, but I want it to be focused on external consumer facing communication. So, a thing I've noticed at a lot of regulatory agencies, the FDIC, the CFPB, the SEC, a whole bunch of different organizations, is well, they mostly focus on supervising and enforcement within their industry areas that they're statutorily defined. They also try to communicate to citizens, to consumers, right? So the CFPB tries to put out bulletins and to communicate to consumers. They take consumer complaints. The FDIC actually publishes like a newsletter where they try to speak directly to consumers and tell them like how to evaluate fintech companies and where it's safe to keep your money. But candidly, they suck at that, right? They're horrible at that. And when you think about trying to get people's attention in this digital age, I think we need to outfit government agencies with much better capabilities for communicating to the public. And like the CFPB wants to do, at least under Chopra, like a credit card comparison shopping website. Candidly, I would love that. I would love if that existed and was run by the CFPB because it could be a nice counterweight to NerdWallet and Credit Karma, and it wouldn't be financially incentivized to push certain products. Like, I love government actually competing a little bit there, but the CFPB has no ability to build a website that can compare to Credit Karma or NerdWallet. I'd love to up-level their capabilities. So I'm going to manifest greater public communication capabilities for government regulators.
Ooh, and the use of digital to do that. The future's digital, and the future's public-private partnerships to make that happen, where the incentive structure is a little bit different. We have lots of good examples of that historically. The Edgar Date case is probably one of the most reviewed things in the world. It's just very hard to use and ugly, and so there's a whole structure of things that try and make that better. Let's manifest a little more. Well, can I manifest that we do this again next month, please?
Yes, sir. Done.
Look at that. You grant wishes. I didn't know you were a genie, but now we do.
Yes, it is done. Make sure to tune in next month where Simon and I will be at this again. Mr. Taylor, it was delightful to see you. I'm so glad I'm going to be getting to see you in person at a couple upcoming events soon, and we will do this again next month as promised.
Likewise, sir. I'll see you soon.